Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly Video for the 15th of November, right in the middle of the month here in 2022. A lot of headlines to get to, and let's start with what happened first in the morning. That was, at least on the earnings front, Wal-Mart. So Wal-Mart is a relatively large retail company. It has a big market cap, and we do watch this stock, and it's back close to the highs of 2022. So that could be slipping through the attention if we're only looking at the big picture that some of the retail stocks. Now, we'll have earnings from Target in tomorrow's session, but there's this commonality. We had big headline news from retail giants, Walmart and Target, a few months ago into May, and they were talking about how inflation had hurt their bottom line being sales and earnings. That was a shock, and it sent their stocks much, much, much lower. There's Walmart, there's Target. But since then, there has been a flat line. They've both gone relatively sideways. Again, looking at Walmart and Target, two big box retail names, and we'll see what they have to say in their earnings. Walmart was a little bit better. They have cleared out some of their inventory. That was a concern, and the inflation is potentially moderating a little bit. Nonetheless, they had earnings per share this morning, pre-market, and it did result in the strongest gain for the stocks in the S&P 100, gaining about 7%, up to about 8 or 9% by the high. That was about $150 per share. Home Depot, and think of it like Lowe's. I like to pair these together, Home Depot and Lowe's. Home Depot reported earnings, and it didn't move the stock that much, up about 1.5%. But the Lowe's will report earnings in tomorrow's session. Just a quick peek at its current implied volatility, 75%, which gives an expected move up or down currently at about $11.40. So by tomorrow's session, to looking at Lowe's, that could be up about $11.40. We'll put it right about here. That takes it to about 222 and 22. That could also be a result to the downside of that $11. That takes it just back down to 200. Target had its earnings, and after the bell, Target will have earnings after the bell. We'll take a look at its expected move. That's actually a little bit higher at 120% with about $15 up or down implied volatility. So taking Target right with that at Walmart, that takes it potentially to 194 or down 15 to about the 165. So those are the expected moves for Target, Lowe's. But after the bell, we have more. We have Cisco, and won't necessarily go into its expected move, but Cisco will report after the bell, as will NVIDIA. So these are in focus for the next trading session. Target, Lowe's, Cisco, NVIDIA. But today's session was Home Depot. We had Walmart, and we're going to have the others coming up. But that was before the bell. We also had the PPI. The PPI is was at least, let's take you step by step, was a catalyst pre-market. Let's get these overnight hours on just to show what happened pre-market. We'll put these on just to note a very similar thing took place when we saw the CPI. What's the CPI Consumer Price Index? What's the PPI Producer Price Index? What was the headline? Inflation coming down a little bit. And that sent the S&P at least surging right at the report from 4,050 points higher, sent the NASDAQ on its early performance and its news event. It pushed up, roughly speaking, we'll count all these points, on the headline news about 200 points in the NASDAQ. Did that hold? Did the market retain the highs? There's the Dow and there's the Russell. No, the market did not retain the highs because mid-session, something none of us could have predicted, and it was a catalyst event. Geopolitics, we'll call it headline news. It's why we manage risk and do the option contracts and do use stops with intraday positions. Nobody could foresee a missile or rocket going astray, hitting a target hitting a non-target, I should say, in Poland. That was a catalyst in the mid-session to collapse the stock market, roughly 50 or 60 handles in the S&P, and the NASDAQ collapsed it over 200. It was a catalyst, however, for oil to surge at one point about 3%, getting right into our target, 88.50. And these are catalysts. Catalyst is a news event that we don't know that it's going to happen. We do know earnings. We do know CPI. We do know PPI. We know the jobs report. And we know Fed days. We know volatility will be high. But as traders, there are just things that are out of our control, and that's where stops, or sometimes they'll play in the positions where we are positioned, and that will benefit. Other times it will not. Again, spreads and option strategies do mitigate risk on unknown events that can send markets flying or crashing mid-session. And that was a headline news in today's trading session. And that did affect markets across the board. There's gold. Gold continues its rally higher. And the bond market, all things being equal, did continue its bullish pressure or upside action in today's session. TLT closed up about 1.6%. Similar in the bond products in the futures market, 30-year Treasury bond and the 10-year Treasury note. That is right in line with this deeper pullback for the dollar. It's seeing the biggest decline in 2022 in terms of movement or percent movement off the high. And that has broken the trend lines. But again, the main concern is inflation. And if the data are coming out, short-term data, of course, but they are coming out a little bit better than expected, inflation may be peaking, that is going to send these trends or send these markets in a reaction the other way. And for the dollar, that's to the downside. For the Treasury notes, that the yield, the rate on the Treasuries, that's to the downside. In the bond market, that is to the upside. And to the equity market in general, that is back to the upside. We're continuing to see, the way I'm framing it with us here in TheoTrade, is the fourth, maybe call it the fourth, but it is a bear market rally. We might not want to call this a bear market rally because it wasn't really a bear market in January, but they did come in earnest in March and beyond. But making a note here in the S&P 500, this was roughly a 450 or 500 point rally. The other bear market rally off the low, this trend line here, was about 300 points. And the rally from back within, that's the strongest one we've seen all year. That was about 550 points. And the current rally took us 400, and it is extending a little bit higher. So I am framing this, at least from my trading and my perspective, as a bear market rally. The third time we've seen a move this powerful off the lows of the down trend line channel. The fourth time was not as powerful, but that's where we are as we're going through November and into December, which ends the year. And it's been a downtrend, bear market, but it has not been straight down. There have been little bounces, and we like to call them here in TheoTrade bear market rallies. And this one does target potentially about 4,100, maybe a little bit higher for the SPX. And that's in play for the S&P stocks. There's the NASDAQ. The Dow mini futures is actually a little bit stronger and not that far off from its highs. It's been more sideways than the NASDAQ, which has been clearly in the downside or the downtrend. And the small cap Russell, even though it had a very weak showing in the earlier part of the year, has held its own and been more sideways to the bulk of July to present. So we are seeing a little bit of stabilization in some of the products. The tech sector does remain, or has remained, under pressure. And that will reverberate through the other sectors, including financials and technology. Skip over to energy, which actually made new highs. It's the only stock or the only sector that's continued to be on the bull side, the upside, and that just pushed off to new 2022 highs, meaning not everything is down. Staples has been sideways. Healthcare has been sideways. And utilities, for the most part, has also been sideways. The bear market is centered and focused around technology stocks. And if we do get that turnaround, if the what I call the inflation pain train does reverse, meaning inflation drives the train, the Fed raises rates. Rates are going to cause the bond market to go lower. Rates are going to hurt the equity market, hurt corporate earnings and profits, and because technology stocks in general rely on lots of capital and do have a greater sensitivity to higher interest rates. They're going to be most affected by rising rates. But the flip side is true. If inflation does start to turn down, the Fed will be less pressured to raise those rates as aggressively as they have, and we'll see tech stocks potentially get a big bounce because they're the ones that have taken the biggest brunt of sell-side activity across the board in 2022, including Amazon, including Netflix. And some of these trends began later in 2021, and that includes Google and, of course, Facebook. So if these stocks are catalysts because of higher interest rates and inflation, if inflation turns the other way, and that's a big if, these stocks could be the benefits, or at least have larger or outsized percentage gains in some cynical way, just simply because they've been beaten down and trended down so much that a $10 move in Meta is a larger percent move than something that is priced a little bit higher, which would include Home Depot or Wal-Mart and other stocks. So that is something to watch as we go through the remainder of November. Of course, headline news, earnings, retail, the consumer confidence, and any additional inflation data, good or bad, which could move markets up, down, and anywhere in between those two. As always, be careful and safe. This is Corey Rosenlund with tonight's Theo video update for November 15th, 2022.